All right, today we are tackling a huge question for anyone looking for income from their investments. How do you get those really attractive monthly payouts from an ETF without watching your original investment just shrink over time? We're going on a hunt for the exceptions, the highest yielding covered call ETFs that have actually managed to grow.
I mean, this is the central problem, right? You see these ETFs with these massive double-digit yields, you get excited, but then you pull up the chart and the share price just seems to be on this slow, painful slide downwards. It can feel like you're holding a leaky bucket, where that income you're getting is really just your own money being handed back to you, minus a little bit each time. So the question is, how do we find the funds that actually avoid this trap? Okay, let's dive into this. At the heart of it all is the covered call ETF. The strategy is actually pretty simple. The fund owns a portfolio of stocks, and to generate some extra cash, it sells call options against those stocks. You can think of it like renting out the potential upside of your stocks. In exchange for that rent, which is called a premium, you get a monthly payment. And that premium is what gets passed on to you, the investor, as that nice monthly distribution. But, and this is a big but, here's where the danger comes in. It's this thing called NAV decay. Now NAV, or net asset value, that's just a technical term for the ETF's share price. And when a fund's strategy constantly puts a lid on its potential gains, but lets it feel the full force of any losses, well, that share price can slowly bleed out over time. And that doesn't just eat away at your initial investment, it also means your future dividend payments will likely get smaller and smaller. It's the silent killer we're trying to find a way around. So that sets the stage for our mission. We are going to sift through the entire universe of these popular income funds to find the survivors, the very few that have managed to deliver that high income without causing that dreaded NAV decay. Our search started with a pretty big list. We looked at a database of about 65 different covered call ETFs, and that's a lot. It just goes to show you how popular these things have become in the last few years. And this is where it gets a little bit shocking. We applied one very simple but absolutely critical filter. We said, okay, we only want to see funds that have actually preserved or, even better, grown their share price since day one. We're kicking out every single fund that has that NAV decay problem we just talked about. And just like that, our list of 65 gets slashed all the way down to 27. I mean, think about that. Less than half made the cut. That really tells you just how common this NAV decay problem is. But from this much smaller, more elite group, we can now find our top 7 highest yielders. Kicking off our list, we have the 2 highest yielding funds of them all. And maybe it's not a huge surprise that they both have the same underlying asset. And it's a very, very volatile one: Bitcoin. So, at number 1, we've got MAXI, with a trailing 12-month yield that is, honestly, it's just mind-blowing, over 32%. And it did that while growing its NAV. Right on its heels is BTCI, another Bitcoin fund. The yield is also super high, but look at the difference in assets under management, or AUM. BTCI is a much bigger fund. Another really important difference is that BTCI's monthly payouts have been a lot more stable and consistent, whereas MAXI's have tended to jump around quite a bit. Okay, so moving from the Wild West of crypto, our next group of contenders takes a completely different path. We've got a trio of funds from Global X, and they focus on the big, stable market indexes that we all know, like the S&P 500 and the NASDAQ.
And the secret to their success is that they all share the same DNA. It doesn't matter if it's QYLG on the NASDAQ, XYLG on the S&P 500, or DYLG on the Dow, they all use the same playbook. They have a nice, low expense ratio, and most importantly, they only sell covered calls on half of their portfolio. The other 50% is just left alone to grow, to capture half of the upside of whatever index it's tracking. And that hybrid approach is really the key to how they perform so well.
Now, to round out our list, we've got 2 more really unique strategies. First up is IGLD. This one generates a really impressive 17% yield by running its covered call strategy on gold. And then there's QUSA, which is the newest fund on our list. It's actively managed, and the idea here is to handpick what they call quality U.S. stocks, big names like Microsoft and Visa, and then write options on them to try and hit a 15% income target. Okay, so we've got the what. That's our list of 7 funds. But now we've got to get to the most important part, the why. What is it exactly that allows these specific funds to pump out such high income without destroying their own share price?
For MAXI and BTCI, the secret ingredient is pretty obvious: extreme volatility. Their underlying asset, Bitcoin, has price swings that are nearly 5 times bigger than the S&P 500. And when you're talking about options, that volatility is everything.
And that leads us straight to this fundamental point. In the world of options, volatility is king. The more an asset's price jumps around, the more expensive its options become. So for a covered call ETF, higher volatility means they can collect a much bigger premium for selling those calls, and that translates directly into higher payouts for you, the investor. You combine that with Bitcoin's massive price run-up, and you have the perfect recipe for these huge yields. But for the Global X funds, the strategy is completely different. It's way more subtle. It's not about volatility. It's really all about taxes and that 50-50 portfolio split they use. So here's how it works. These funds are what's called a regulated investment company, or a RIC. And because of that, they're required by law to pay out at least 90% of their gains to shareholders every year. Now, remember how half of their portfolio is just left to grow? Well, in a really strong market, that half racks up some huge capital gains. And to hit that 90% payout rule, the fund is forced to make a massive catch-up payment at the end of the year, usually in December. And that one huge payment dramatically inflates their trailing 12-month yield, making it look incredibly high.
So you can see why understanding these mechanics is so crucial. Let's wrap this all up by putting together a simple checklist. If you're looking at one of these funds, or any covered call fund for that matter, these are the variables you absolutely have to understand before you even think about investing. First, what's the option strategy? Are they selling calls at the money, which gives you the biggest premium but also caps almost all of your upside? Or are they selling out of the money for a little less premium but more room for growth? Next, what's the coverage? Is it 100% covered, or is it that 50-50 split like the Global X funds use? Then, what's the actual underlying asset? The risk of a Bitcoin ETF is obviously on a different planet than an S&P 500 ETF. And finally, is it actively managed or just tracking an index, and what are they charging you for it in the expense ratio? All of these things work together to create the fund's unique fingerprint of risk and reward.
And that brings us to the final, and really the most important question you have to ask yourself. Just because these 7 funds have avoided NAV decay in the past, that is absolutely no guarantee they'll do it in the future. A monster bull run in Bitcoin or a huge tech rally can make almost any strategy look brilliant. The real question is, now that you understand the mechanics behind the curtain, which of these strategies, if any, truly fits your own financial goals and, just as importantly, your own tolerance for risk? Thanks for tuning in.